Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, May the 21st, 2025, recording this in the morning. Okay, so let's have a look and see what's going on. The main thing, really, I think, which is getting the market's attention at the moment, there's a lot of horse trading going on in Washington about the so-called reconciliation bill, which is like kind of like the mini budget. And it looks as though that's going to come to the floor of the House, maybe even as close as tomorrow, according to the Speaker, Johnson, this morning. But the point is that the market is getting quite worried that there's not going to be enough sort of spending, and there's going to be, on the other hand, tax cuts. And so, in a certain sense, those tax cuts will not be fully funded. And that's starting to put sort of upward pressure on a lot of sort of yields, especially in the US. We're seeing here the 30-year yield here. Which we'll get back to in a second. But also over in Japan, we also have the 30-year yield in Japan now over 3%. We have a 40-year auction, or the auction for the 40-year, a very, very long Japanese bond coming up, I believe, tomorrow on Thursday. So it's going to be interesting to see if that goes well. Remember that the 30-year auction a couple of days ago in Japan went quite badly. There wasn't that much demand. So the point is here is that we're getting these long-term yields all over the developed world going up. And if we look at the case of Japan, if you're starting to get, let's say, a 30 or a 40-year bond paying, 3.5%, 4%, what that means is that maybe banks and life insurance and pension funds in Japan, they may not have to go outside, let's say, to the US to get these kind of yields, because remember that if they're getting yields in the US, they have to worry about a depreciating US dollar in terms of their yield income. And secondly, they have to hedge that, all of which is costing money. So long story short is that as the yields are going up on the Japanese 30-year bond, that could, and we'll just have a quick look at that. Let's just have a quick look here. I'll just throw it up. So I think we put in JP. That will bring it up here pretty quickly. You can see that that's actually gone up now to 3.2%, just coming off a little bit today, but basically pretty high. And what that means is that there's the temptation for some of these large players in the Japanese space to kind of sell their holdings of US treasuries, long-dated US treasuries. And in doing so, they'll then have to repatriate the money. So they'll have to convert those US dollars they'll get from those sales back into Japanese yen, which could cause, a bit of a strong bid in the Japanese yen. And in fact, we've seen the yen going up a little bit over the last few days. So quite interesting flows going on. Now, just getting back to the US here, we have this 30-year yield. And as I say, we do have a 20-year auction today. So today at 1 p.m., we have a 20-year auction. And keep in mind that the 20-year auction is actually the most sort of unfavored one in the US. And just because it's a duration which, apparently the large players don't love as much as others. And if we actually look at that, just interesting to see what's happened to the US yield curve here. So just bear with me in a second. I just want to look at the US yield curve. Let's have a look. Bonds, USTs, US curve. I think this is the one. Let's have a look. Right. Okay. So sorry, what's going on here? All right, so if we look at that here, yeah, you can see that just the tenor going all the way out. But if we actually look, let's say, for example, from a week ago, let's have a look here. You can see that that's moved. You can see that that's moved quite a lot. And if we go back a month or so, you can see how much that's moved up. So the point is here is that the curve has moved up, as much as 20 or 30 basis points, depending on where you look, and all across the curve that it's moved up. So this is starting to put pressure on the back end of the curve. Sorry, just getting back here. So if we have a look now, we can see that the curve in the US on the 30-year, it's now above the 5% mark, which is this purple line. Now we've got there before, we got there back in the beginning of January, also in the middle of April, and even in the last few days we've touched it. Now in the last few occasions, that 5% has been a buying opportunity in the sense that that yield has proved to be fairly attractive, and buyers have come in pushing the yield down. And we even had that yesterday and a couple of days ago. But what's interesting is that we've had another push up overnight, and this does look as though it wants to break out. So at a certain point, if this starts to break out, this is going to obviously put upward pressure on mortgage rates, which are normally about 200 basis points higher than this. So you're starting to get into 6.5%, 7.5% mortgage rates, and that could cause the authorities to sort of move. The administration will not like that. And the other issue as well is that as these nominal yields go higher and higher, of course, you've got the real yields going higher and higher at the same time, as long as because inflation is relatively anchored. And that's going to start putting some pressure at some point on the equities because the equities cannot compete with very, very high real yields. So let's just have a look and see what's going on in that space as well. We can see volatility is still, I mean, it's not super low. For a long time over the last few years, it was, in the sort of the 14, 15, 16 mark. So we're at about 18 and a half, had a tiny little pop overnight and subsequently come down just a little bit. But basically, volatility is still, historically, at least in the last kind of couple of months, at a relatively low level. So that's not a huge issue. But it is starting to creep up just a tiny bit. If we look at the equities, you could see here on the ES that they are starting to come down a little bit. This is still a bullish chart technically. We still have the 20-day crossing over the 50-day. So these moving averages are slowly moving up. We're above any sort of Fibonacci retracements. We're above this local high. We're above the Trump tariff. So the point is this is still a bullish chart. And if we break that down, let's say to a 4-hour chart, I'll just put this here and get a Fibonacci here. Let's have a look. You can see that even if we just take this, sort of shorter term impulse, we haven't even got back to a 38% retracement yet. So yes, it's come off for a couple of days, just a little bit, but this is still a bullish chart. And at this point, the bears are definitely not in control. It still remains in an uptrend. And so you've got to say that, absent, specific catalysts, it still seems to me that there's no obvious catalyst or reason for this to go down today, which is not to say that the market is not looking at those higher yields on the 10-year and the 30-year and is not also looking towards Washington and wondering whether the Trump administration is indeed becoming too fiscally kind of extravagant. So that's something to look out for. The other thing as well, just in terms of the bond market, is that we had the inflation numbers from the United Kingdom this morning. They were quite a bit higher than expected. That's also putting upward pressure on the gilts, on the yields, on the gilts. So as I'm trying to say, all across the world, Japan, US, UK, there's sort of pressure going, putting sort of upward pressure on those yields. Also over in Germany, remember that they are still about to start spending that money on infrastructure and defense. So the point is the days of having, 10 and 30-year yields at sort of 50 basis points are gone for the moment. And it's just going to be interesting to see how global economies cope with that. Again, just to finish off on the bonds, as we kind of thought, after the weekend, I mean, basically everything's sort of steepening. If you've got sort of, again, a US administration spending a lot of money, which is not particularly going to be sort of funded by cuts, that's going to sort of steepen the curve here. And if we actually just look here, at a couple of these yield curves. So if you look at, let's say, the 2s to the 10s, you can see that's started to steepen again. If you look at the 2s, 30s, that's starting to steepen. And the one which I'm looking at as well is the 10s, 30s. So you see that the 10-year yield is going up, but the 30-year yield is going up even more. So you see that the 10s, even the 10-30 yield curve is steepening. So all across the curve, we're getting steepening. What we're not really getting a lot is a huge amount of movement at the front end. This is just the outright yield on the 2-year. So you see here on the 2-year in the US, as you guys can see here, it's moved up a couple of basis points. But let's compare that to, let's say, something like the 10-year, which has moved, gapped higher, and then even the 30-year, which, as you can see, has gone up a lot more. So really, these yields are moving up a lot on the long end. And what that's telling us is that the market is concerned by as I said, the fiscal sort of lack of discipline in Washington. It's concerned about maybe a lack of buyer interests. For example, if some of these Japanese, sort of real money players sort of stop buying the US treasuries, it's also worried about a lot of government spending. So the point is, it's almost saying that what it seems to be telling us is that the market doesn't believe the Fed will cut aggressively, but it still believes that at some point there is a possibility that the US economy and maybe even the global economy will kind of slow down a little bit. So just interesting to look there. And we can see that reflected on the just the pricing for the Fed. So if we just have a look at the function here. Yeah. You can see that now the market seems to have settled in. It was a lot more dovish. It was up to 3 and 4 cuts, sort of a month or so ago. But as you can see now, it's just 2. So the market is basically saying two cuts by the end of the year seems to be the sweet spot for the US. And then if we look at towards the end of 2026, about 4. So basically saying 2, and then another couple in 2026. We'll see what happens with, Trump's tariffs and the whole deal. Okay, so apart from that, just grab some tea here. Not a huge amount going on today. What we did have is the earnings from Target and Lowe's. We just had those. Target seems to have been a little bit of a disappointment. So lower sales in the stores. The forward guidance seems to be a little bit pessimistic. The EPS I think was lower than expected. So Target came in. So you see here, Target sees sales declining by low single digit. Saw a little bit of growth. So fairly pessimistic from Target. On the other hand, we had Lowe's, which is the home improvement. And basically, just reading through quickly this morning, what they seem to be saying is that they're doing okay, but people are spending money on smaller items. So the bigger items are not being spent on, but people seem to be spending money on home improvements with smaller items. So a bit of a mixed bag, but definitely Target was, a lot weaker than expected. Not a lot of data today. We do get the mortgage applications expected to be less. And maybe that's no surprise with the real yields going up on the 30-year. Let's keep an eye on that. Tomorrow we have a bit more data, which we can talk about initial jobless claims and some of these PMIs starting to come in for May. So we might start to get more of an effect. But probably the most important thing over the next day or two, just in the absence of a lot of economic data, is a couple of geopolitical events. So first of all, well, actually, I'll deal with the G7. So we have the G7 finance ministers and also the central bankers all meeting in Western Canada for the next couple of days until tomorrow, I believe. So as I mentioned the other day, Besant, the Secretary of the Treasury for the US, is having bilateral meetings. What the market really wants to understand is there going to be any sense, possibly in the communique, although that's a low probability event, but any sense with headlines or sort of comments that the US behind the scenes is putting pressure on some of its trading partners to strengthen their currencies. And I'm talking about currencies maybe like the Japanese yen, or even not that the Chinese are there, but let's say, the Europeans, just their trading partners to basically say, hey guys, we in the US need a weaker US dollar, rather than, or, sort of, in order to have lower tariffs, we either need to have high tariffs or we need to have a low US dollar just to help the US improve its sort of export situation. So it's going to be interesting to see if any headlines like that come out or any sort of hints, and obviously in the communique happening tomorrow afternoon, which probably won't reflect that because, as I reminded you yesterday, that communique for the last 20 years has essentially said that FX rates need to be set by the market and not meant to be manipulated by governments or administrations. So any hint of a change to that would cause, I think, a fairly major reaction. We could see strength in something like the yen, and other currencies against the US dollar, but we're not there yet. In terms of other stuff as well, there was a headline yesterday, a report. Um, so let's just have a look at oil. So basically, and gold. So basically, there was a report that the Israelis are sort of planning a potential preemptive strike on Iranian nuclear facilities. We know that at the moment there's quite fractious sort of negotiations going on between Iran and the US about sort of kind of de-escalating the Iranian nuclear development program. I don't know if they're going to be successful or not, but there was a report anyway that the Israelis are saying, forget all that. We might just go in and preemptively try to take out or destroy Iranian nuclear facilities. Obviously, that's a significant risk. Obviously, Iran is a fairly major producer of oil. So what we've seen there, apart from the weaker US dollar, we've also seen gold here breaking out. A little bit of this is going to be geopolitical risks. So you see here, gold, seems to have been bought on that 50-day moving average on that fib level here, and indeed it is sort of pushing a little bit higher, but it's got a little bit of a hurdle here, a short-term hurdle. It's now just from this short-term retracement. This is the 61% at the 33.25 level. So the first thing the bulls have to do is to push above that. So let's see if it can't get above that by let's say the next 36 hours. I do believe there's a possibility that it drifts down a little bit. So pretty key level there. But just getting back to the Israeli thing, so we're also on slightly weaker US dollar, but oil basically having a little bit of a pop, about $1. You can see the pop here on the daily chart. But as we can note on the chart here, that sort of geopolitical risk, that was basically at that recent high of about $64. It couldn't sustain that. So keep an eye on that today. So that's interesting that, we did have a pop of about about $1.50 on oil on that headline about Israel and Iran, but it seems to be finding it difficult to sustain that rally. And what's also got my attention, obviously, we see gold sort of breaking out, or is it? But I'm just keeping an eye on the copper market, which is quite a lot of complex dynamics there at the moment, which I won't go into in this video. But if you look at copper here, it's been in a pretty tight sideways consolidation here. As you can see here for a couple of weeks, just here between the 50 and the 100-day moving average. Is it popping higher? At the moment, there are certain global forces. I was reading this morning some research out of the in Hong Kong. There was a speech delivered today by Mercuria. Anyway, basically saying that structural reasons, there's quite a lot of structural shortage of copper. Could it push higher? Maybe. It's interesting if this wants to pop higher, but the fact that it's finding it difficult, I mean, it's coiling in energy. It's kind of stuck between this idea that there's a structural shortage, but on the other hand, especially in China, there's quite a lot of pessimism about the future of the short-term future of the economy in China. So that's something interesting to watch in terms of a global well, a bellwether for the global sort of economy. In terms of other stuff, as I said, target down a little bit, pre-market lows up a little bit. We spoke about the equities. So the one thing to think about as well is that gold, the US dollar actually having a little bit of weakness. If we look at some of the currencies here, where are we? Here's the dollar index. So you see the dollar index now down below 100. So exactly at that sort of this downtrend here, the 20-day, sorry, the 50-day moving average, also this Fibonacci retracement, the dollar index couldn't, muster any energy above that. So it looks like the dollar's on the way down here. And you've got to say, if there's still a concern that the US is lacking in fiscal discipline, it's debasing its currency, it's overspending, these deficits are not sustainable. And essentially, it could be that some major players, some sovereigns, maybe even exiting their, at some point, are reducing their US dollar, their US Treasury positions, and just trying to get a little bit out of US assets, just lightening up. It doesn't mean they're selling everything. It just means they're lightening up a few percent, and that's enough just to cause, sort of major players to go into things like other liquid and safe currencies, like for example the Swiss franc, which has been doing pretty well. If we just go here to the Swiss franc, let's have a look. So USD CHF, you can see USD coming off again against the Swiss franc, and the euro also sort of pushing a little bit higher. So it looks as though the dollar's under pressure. The Japanese yen also has strengthened. This is the US dollar weakening here against the JPY, and that does look as though it's broken down below the moving averages here, rejection. So it does look at, at a minimum, it could get down to, let's say, 142, or might even want to test down to the very, very important 140 level, which you can see is a very important level. We'll see what happens there. Okay, guys, so I'm going to leave it at that. We've had a few Fed speakers. Yesterday we had Bostich. And a couple of others essentially saying that they're waiting for more data and that they need more information. I expect that's what the Fed will be saying today. And there's a couple of other Fed speakers. As I said, we have the 20-year auction at 1 p.m. That could be interesting. It's a little bit technical. That's not really a loved tenor. But if that goes well, that could give a little bit more confidence, could push down or bring down the yields on the 30-year, which could give equities a little bit of a boost. On the other hand, of course, if that auction does not go well, I do believe that will obviously push the yields up on the long end of the curve, which I think will further pressure the equities, and also interestingly the US dollar. The US dollar is trading a little bit at the moment like a country which has a sort of a fiscal a sort of problem. So rather than those yields causing the US dollar to go up, at the moment we're seeing that when those yields spike too much, it's actually pushing the US dollar down, which means that those correlations are changing. And as I say, just keep an eye on any headlines coming out of the G7 meeting in Canada about currency adjustment or manipulation. Okay, I'll leave it there. Have a great day. We'll keep the conversation going. Thank you.